Welcome, everyone, and thank you for joining us today for another edition of Overberg Asset Management Global Markets Q1 Review and Outlook for 2026. Overberg Asset Management, boutique level care with global and local expertise, personalized to our clients with a holistic view on wealth and asset management. Presenting today is Nick Downing, CEO and Chief Investment Officer of Overberg Asset Management. Markets this year have been anything but boring. We've had equity rebounds, bond sell-offs, oil shocks, and geopolitical storms to match the cold fronts hitting the Western Cape. In the presentation today, Nick is going to walk us through the Q1 review of the global markets, share his economic and market expectations for the year ahead, unpack projected asset class returns, and give us his take on the OAM Global Portfolios. In short, if you've been wondering what to make of the world right now, you're in exactly the right place. Nick, over to you.
The outbreak of war in the Middle East at the end of February, when the US and Israel launched military strikes against Iran, disrupted the Strait of Hormuz and sparked a surge in oil prices, causing a sharp reversal in risk appetite. The Brent oil price surged from $74 per barrel at the start of the year to a high of $120. Equity markets that had led the rally in the first 2 months of the year surrendered much of their gains in March. Despite the geopolitical turbulence, the underlying global economic expansion remained intact, supported by monetary and fiscal stimulus, an AI investment boom, full employment, and buoyant business and consumer confidence. Global purchasing managers' indices remained in expansionary territory, confirming continuing growth in global services and manufacturing sectors. After falling in March, the world's major equity markets rebounded in April, following the announcement of a ceasefire in the Iran war. The strength of the equity market rebound was slightly surprising, given little progress in finding a peace deal and the continued blockade of the Strait of Hormuz, through which roughly 20% of the world's oil and LNG is transported. Despite the residual uncertainty, the MSCI All-Country World Index exceeded its pre-war high, even though the oil price remains 50% above pre-war levels. The chart shows the rebound in equity markets was driven by upgrades in forward earnings estimates across all major markets except for China. The biggest upgrades are Korea, Latin America, and Taiwan, driven by the accelerating demand for semiconductors and a broadening in global growth, which benefits emerging markets. Earnings upgrades exceeded the net increase in equity indices, hence a fall in market PE ratios. The equity market rebound was led by technology and AI-related sectors, which had been in the doldrums since last October. This was especially evident in the US, where tech companies comprise 33% of market capitalization, but also in the Far East, especially in Korea and Taiwan, which are heavily exposed to the AI investment boom. The US hyperscalers produced strong Q1 results, showing better than expected revenue growth, with cash flows rising in line with a surge in capex. Indeed, demand for AI appears to be strengthening. The chart illustrates the performance of different sectors in the S&P 500 index before and during the US-Iran war. There has been an exceptional rebound in the performance of tech and AI-related sectors compared to the remainder of the market. While equity markets have been resilient, sovereign bond markets have suffered from the inflation crisis. Government bond yields have increased to their highest levels since the war began. The correlation between changes in the price of Brent crude and 10-year government bond yields in major economies has become strong since the start of the war. Central banks have pared back their willingness to ease monetary policy, adding to the lift in government bond yields. G7, ex-US, 10 and 30-year government bond yields are in uptrends and near multi-year highs. The oil price surge has lifted long-run inflation expectations. In the US, 10-year inflation expectations measured by the 10-year CPI swap rate have jumped since late February by 20 basis points, with similar moves in the UK and Germany, also measured by similar maturity inflation swap rates. So now let's move on to what we're expecting in the future. The war against Iran has created uncertainty for financial markets. Although a re-escalation of the armed conflict now seems less likely, a peace deal that keeps the Strait of Hormuz open also looks a long way off. The baseline view to start with was that we are getting a taco, Trump always chickens out. But so far, we are getting a nacho, not a chance Hormuz opens. Markets do not like uncertainty. However, even if the conflict resumes, a ceasefire is still likely to resume within another month or two. Both Iran and the US have a strong incentive to avoid a prolonged war. In the worst case scenario, the world economy could face stagflation. Stagflation is when inflation soars while economic growth slows, a dire combination for financial markets. Stagflation could occur if there is long-lasting damage to productivity capacity in both Iran and the Gulf. Brent crude could rise to an average of $150 per barrel over the next 6 months or so, and the subsequent price decline would only be gradual. In this scenario, global GDP would average just 1% annualized in the second half of the year, meeting the definition of global recession. Meanwhile, inflation would rise to over 5% in the Eurozone and 4% in the US. Futures markets are predicting that central banks will respond to higher energy prices by hiking interest rates in the year ahead by around 60 basis points across major economies, but a milder 10 basis points in the US. However, even with these rate hikes, real one-year forward expected policy rates for the major economies are very low and do not threaten the global economic expansion. The rise in the oil price has had limited impact so far on global economic activity. Although the oil price is almost doubled since its pre-war level, its increase in real terms versus other oil price shocks is less alarming. When adjusted for inflation, the oil price is only slightly above its post-1970s average. Meanwhile, oil usage intensity has been steadily declining. Global crude oil consumption per unit of real GDP growth has dropped by over 60% since peaking in the wake of the Arab embargo in 1973. The impact could prove even more subdued once the Persian Gulf reopens, with significant plunge in oil prices expected. The UAE has formally withdrawn from OPEC after 58 years of membership. The move allows the UAE to increase oil production capacity beyond previous quota restrictions. Saudi Arabia, as well as other Gulf countries, will be incentivized to produce as much oil as possible after transportation restrictions are lifted, to repair their infrastructure and to punish Iran. The chart shows the decline in global crude oil consumption per unit of real GDP. Last year, it was just 35% of its level from the 1970s. Fiscal and monetary settings remain positive for global growth. Despite higher energy prices and geopolitical uncertainty, recent economic data have generally held up well. The US composite PMI even rose marginally in April, with the manufacturing sector PMI rising higher into expansionary territory. Although services dragged down the Eurozone and Japan composite PMIs, the manufacturing measures continued rising, extending their steady recovery. Meanwhile, payrolls in the US increased significantly in March, together with sturdy growth in retail spending. In China, Q1 GDP grew well above its underlying trend rate, with year-on-year growth accelerating from 4.5% to 5.0%, boosted by strong growth in manufacturing, particularly in tech industries. Contrary to expectations, US economic activity has accelerated despite the Iran war, as illustrated in this high-frequency GDP growth indicator. The Dallas Fed's weekly economic index, shown here, confirms an uptrend in the rate of US GDP growth. The global economy is experiencing a broad-based acceleration in response to last year's central bank rate cuts and greater fiscal spending. Globally, services, manufacturing, and exports are all in an uptrend. A further rise in corporate earnings should propel equity markets higher in the year ahead. Although returns will be constrained by already elevated valuations and the advanced stage of the investment cycle. However, there is a lot of stimulus in the pipeline: low real interest rates, fiscal stimulus, and the AI investment boom. Once the Middle East conflict ends, there will be additional stimulus via lower oil prices and the rebuilding of infrastructure in the Middle East. Once the war is ended, the economic backdrop will potentially be even better than it was at the start of the year. And we're now turning to OAM's Global Portfolios. HG Capital's shares have undergone a sizable de-rating since the start of the year due to the existential crisis faced by software as a service providers in the face of agentic AI solutions. According to HG Capital, its portfolio of companies are defended by wide moats, including proprietary data and specialized mission-critical business processes. However, AI alternatives are expected to improve exponentially, and the direction of travel, however gradual, will incrementally work against the valuation rating multiples and earnings growth of software as a service providers. We are not convinced by the argument of HG Capital's proprietary data. The data surely belongs to HG Capital's customers, and they will no doubt be looking for cheaper AI service options as they become available. HG Capital has been a core holding of OAM's global portfolios for several years and has compounded massive returns over time. But it was time to exit the investment. We allocated a portion of the proceeds from the sale of HG Capital to the existing holding in the Van Eck Defense ETF, which provides diversified exposure to global defense companies, including those in defense technology and cybersecurity, spanning firms across the US, Europe, and Asia. As the world pivots from arms control to arms proliferation, the need to modernize military capabilities after years of neglect and the rapid change in defense technology will require long-term spending commitments for at least a decade or more. Defense technology is relatively inelastic, which means that regardless of economic cycles, governments will continue to allocate large budgets to it. Investment in defense will also act as a hedge against geopolitical instability. The AI supercycle is a global opportunity. The structural forces at work are real, and the productivity gains are beginning to show. At NVIDIA's annual GPU technology conference in March, the CEO, Jensen Huang, declared that the industry had reached a Windows moment for agentic AI. The most significant development of the past 18 months is the rapid emergence of Asia as an AI investment opportunity. We recommend a substantial global technology and AI adjacent equity exposure structured across two complementary pillars. The first is core US exposure. Overberg's largest single holding across its managed portfolios is the Allianz Technology Investment Trust. The second pillar is Far Eastern exposure, where Overberg holds both the Schroders Asia Pacific Investment Trust and the Schroders Oriental Income Investment Trust. We also hold a large exposure to Fidelity China Special Situations, providing access to deeply discounted Chinese technology companies. Being too bearish on the Middle East crisis runs a high risk. We have already seen over the past 2 months that the market can get whipsawed on any positive headline, especially as the underlying economic backdrop and outlook for company earnings remain positive. There is heightened geopolitical uncertainty, and the timetable and results of the negotiations are uncertain, but both have an incentive to wind down the war reasonably soon, which would include a full reopening of the Strait of Hormuz and a significant decline in oil prices and financial risk premia generally. Yet the spectre of stagflation, even though a low probability, demands a slightly higher than usual cash weighting in portfolios. The chart shows a selection of forecasts made by independent research firm Capital Economics for major equity markets. Over the remainder of 2026, the dark bars, and in 2027, the light bars. Mid-single-digit returns are expected in most markets in 2026. Valuations will eventually become sufficiently stretched that a correction is likely, but most probably not until 2027. Note that these are local currency forecasts. Expected dollar weakness would undermine the relative performance of the S&P 500 index in common currency terms. OAM has a long track record in managing global private share portfolios, going back to 2002. The annualized return in pound sterling net of all fees is 7.07%, and in rand terms, 9.21%. Stronger in 2025, when the OAM growth portfolio beat its benchmark by a substantial margin. Performance in Q1 2026 slipped below benchmark. Although since the market rebound in April, the portfolio has been rapidly catching up. Asset allocation and global allocation is diversified across asset classes, regions, and currencies in a private, actively managed, multi-asset class global portfolio. The balanced portfolio shows a similar trajectory, although due to its lower equity exposure, exhibits less volatility. The annualized return is in fact slightly above that of the growth portfolio, due to unusually strong returns in the bond market in the decade following the 2008-2009 global financial crisis. The annualized return in pound sterling net of all fees is 7.25% over the past 23 years, and in rand terms, 9.49%. Here is the summary. Our base case scenario is that the Strait of Hormuz will open reasonably soon. Both the US and Iran have an incentive to wind down the war. Assuming the war winds down, the stagflation threat will give way to falling inflation expectations and global economic expansion, providing a positive backdrop for risk assets. The benign global economic outlook is a tailwind for an expected global earnings growth rate of 20% in 2026. Emerging market earnings growth is expected to be even higher at 35%, aided by Asian semiconductor companies. Markets won't factor in a global recession unless the oil price challenges the $150 per barrel level. But the more likely outcome, with an end to hostilities, is for the oil price to plunge. Global ex-US markets, the worst affected by the energy crisis, are likely to rally the most when the war ends. The AI supercycle is a global opportunity. The structural forces are real, and productivity gains are already beginning to show. Portfolios have significant exposure across the US and Asia. Thank you for attending our webinar. Please contact us if you would like any further information or have any questions.